There's a number sitting on the balance sheets of America's regional banks right now that almost nobody in the mainstream financial press is explaining in plain language. That number is $306 billion. That is the current level of unrealized losses on securities portfolios across the entire United States banking system as of the fourth quarter of 2025, according to the FDIC's own quarterly banking profile released in February of 2026. $306 billion of losses that exist on paper, invisible to the average depositor, not counted against the bank's publicly reported capital, sitting dormant and quiet until the moment a bank needs to sell those securities to meet a withdrawal demand it cannot cover from any other source. That moment is called a liquidity event. And right now, in April of 2026, the conditions for a liquidity event at vulnerable regional banks are assembling with a precision that anyone who watched March of 2023 should find deeply familiar. The Iran war began on February 28th of 2026 and sent mortgage rates surging from 5.98% back above 6.4% in a matter of weeks, reversing months of affordability improvement overnight. Investment-grade credit spreads ballooned to 120 basis points as of March 18th of 2026. High-yield bond spreads surged toward 470 basis points. Nearly $900 billion in commercial real estate loans are scheduled to mature this year alone, the majority of them held by regional banks that originated those loans in a dramatically different interest rate environment and are now watching the collateral values on those loans deteriorate in real time. The Federal Reserve's own 2026 stress test, released in February, imagines a scenario in which commercial real estate values fall 39% and equity markets collapse 58%. And the first bank failure of 2026 has already occurred, Metropolitan Capital Bank, with an estimated $19.7 million loss to the Deposit Insurance Fund confirmed by the FDIC. One bank failure, quiet, routine, the kind of thing that passes in a press release. The kind of thing that historically appears at the edge of the system before appearing at the center. Watch the edges, because the edges are where the pattern always starts. And the pattern driving what is about to happen to regional banks in this country is one of the most well-documented and precisely repeatable sequences in all of modern financial history. Let me show you the mechanism. It runs in 4 stages. Every banking liquidity crisis in the modern era has followed this architecture, not approximately, exactly. Stage 1 is the vulnerability construction. This is the long, quiet phase. A prolonged period of low interest rates leads banks to lock large portions of their balance sheets into long-duration, low-yield securities. Treasury bonds, mortgage-backed securities, municipal bonds. The logic is straightforward during the low-rate era. Cash earns nothing. Short-term instruments earn almost nothing. So the bank reaches for yield and extends the duration of its portfolio. It buys 10-year and 15-year bonds at rates that seem reasonable when the federal funds rate is near zero. It makes commercial real estate loans at rates and loan-to-value ratios calibrated to a world of cheap money and rising asset prices. It builds a deposit base that relies heavily on large, uninsured depositors, because those deposits are cheap and plentiful. The bank is not doing anything obviously reckless. It is following the rational logic of its operating environment. And in doing so, it constructs the precise vulnerability that will threaten its existence the moment that operating environment changes. Stage 2 is the rate shock. Interest rates rise sharply and faster than the bank's asset portfolio can adjust. The long-duration securities the bank bought at 2 and 3% yields are now worth significantly less in a world where new comparable securities yield 5 and 6%. These losses are not immediately visible. They are classified as unrealized losses on the held-to-maturity or available-for-sale securities portfolios. The bank does not have to report them as losses unless it sells the securities, so it does not sell them. It carries them at amortized cost and weights. The loans it made against commercial real estate valuations that assume perpetual low rates now face a refinancing environment where the math has completely inverted. Borrowers who assumed they could refinance at 3 or 4% are now facing 6 and 7% rates on assets whose values have declined. The pressure is building invisibly. The cracks are spreading inside the wall, unseen from the outside. Stage 3 is the confidence trigger. Something happens that causes a meaningful group of depositors to question whether the bank can meet its obligations. It does not have to be a dramatic event. It does not have to be a proven insolvency. It only has to be a credible doubt. In the digital age, credible doubt spreads in hours. Not days, not weeks, hours. A Twitter post, a news article, an earnings release with an unexpected loss, an analyst downgrade, a Moody's credit rating review. Any of these can trigger the modern bank run, which, unlike the 1930s version, does not require physical lines outside the branch. It requires only a smartphone and online banking access. And once the run begins in earnest, the bank faces the precise problem it constructed in stage 1. To meet withdrawal demands, it must sell the long-duration securities it has been carrying at amortized cost. The moment it sells, the unrealized losses become realized losses. Realized losses hit capital. Capital adequacy falls. The fall in capital adequacy confirms the depositors' fears. More depositors withdraw, more securities are sold, more losses are realized. The cycle accelerates. Stage 4 is the resolution. The bank either stabilizes through emergency liquidity provision from the Federal Reserve's discount window or the Federal Home Loan Bank system, or it fails. If it fails, the FDIC steps in. Deposits up to $250,000 per account are protected. Deposits above that threshold face potential loss unless regulators invoke a systemic risk exception, which requires the Treasury Secretary, the Federal Reserve, and the FDIC to agree that the failure poses a risk to the broader financial system. The 4 stages are not a theory. They are a documented historical mechanism that has destroyed regional and community banks repeatedly throughout the modern era. 1984 and the failure of Continental Illinois National Bank and Trust is the first proof. Continental Illinois was, at the time, the 7th largest bank in the United States. Its balance sheet had grown rapidly through the late 1970s and early 1980s by purchasing energy loan participations from Penn Square Bank in Oklahoma, loans that had been made with excessive optimism about perpetually rising oil prices. When oil prices fell sharply in 1980 and 1981, Penn Square Bank failed in July of 1982. Continental Illinois had purchased approximately $1 billion in Penn Square loan participations, and their quality was now highly questionable. Stage 1, the vulnerability construction through concentrated and aggressive loan participation in a single sector, was complete. Stage 2 arrived through the deterioration of the energy sector and the realization that Continental Illinois had systematically understated the risk on its books. By 1984, Continental Illinois had approximately $2.3 billion in non-performing loans on a total loan portfolio that had ballooned far beyond what its stable deposit base could support. The bank had funded a significant portion of its growth through volatile wholesale deposits, meaning large institutional deposits that could flee instantaneously rather than the sticky retail deposits of ordinary savers. Stage 3 hit in May of 1984 when rumors began circulating, initially through Japanese money markets and spreading rapidly to American institutional investors, that Continental Illinois was in serious trouble. Within 10 days, the bank experienced a deposit outflow of approximately $10 billion. $10 billion in 10 days. At the time, this was the largest bank run in American history, and it happened almost entirely through wire transfers rather than physical branch withdrawals. The Federal Deposit Insurance Corporation, the Federal Reserve, and a consortium of major banks intervened with a bailout package of $7.5 billion to prevent a complete collapse. Because Continental Illinois was deeply embedded in the correspondent banking system, and its failure was judged to pose systemic risk. The phrase, "too big to fail," entered the American financial vocabulary. The 4 stages had completed at the 7th largest bank in the country in a matter of weeks from trigger to resolution. The savings and loan crisis of the 1980s and early 1990s is the second proof. The savings and loan institutions, known as thrifts, were the regional banking system of their era. They took deposits from ordinary households and made mortgage loans. They were legally constrained to hold long-duration fixed-rate mortgages on their books. When the Federal Reserve under Paul Volcker raised interest rates to nearly 20% in the early 1980s to crush the inflation of the 1970s, these institutions were trapped in exactly the vulnerability constructed in Stage 1. They were paying depositors market rates of 10, 15, even 18% on savings accounts, while holding 30-year mortgages on their books that paid fixed rates of 5, 6, or 7%. They were paying more for their liabilities than they were earning on their assets. Every day of operation was a loss. Congress responded by deregulating the thrift industry in 1982, allowing savings and loan institutions to diversify into commercial real estate, junk bonds, and other higher-yielding but far riskier assets. This is the textbook definition of chasing yield to escape an interest rate trap, which is precisely what many banks do in the rate shock phase. Some of these institutions made extraordinary concentrations in commercial real estate and speculative development projects. When commercial real estate values began falling in the late 1980s, Stage 3 arrived through a cascade of failures. From 1980 to 1994, more than 1,000 savings and loan institutions failed. The total cost to American taxpayers was estimated between $130 and $160 billion in 1990s dollars. Entire regional banking ecosystems in Texas, Arizona, and California were destroyed. The Resolution Trust Corporation was created specifically to dispose of the failed institution's assets, selling commercial real estate, loans, and securities portfolios at fire sale prices. The very act of selling those assets at distressed prices further depressed the commercial real estate values that were serving as collateral for other loans, accelerating the deterioration of institutions that had not yet failed. The interconnected nature of collateral values and bank balance sheets is not a historical curiosity. It is an active mechanism operating in the American commercial real estate market right now in April of 2026. Silicon Valley Bank, in March of 2023, is the third and most recent proof. Silicon Valley Bank had built the most precise version of Stage 1 vulnerability imaginable. It had taken in an enormous volume of deposits during the pandemic era, largely from technology companies and venture capital-backed startups that had received massive infusions of capital from stimulus spending, easy monetary policy, and the technology boom of 2020 and 2021. Silicon Valley Bank took those deposits and invested them heavily in long-duration securities, primarily government-backed mortgage securities and treasury bonds, at the low yields available in 2021. When the Federal Reserve began raising rates aggressively in March of 2022, the value of those long-duration securities fell dramatically. By early 2023, Silicon Valley Bank was sitting on approximately $15 to $16 billion in unrealized losses on a securities portfolio of approximately $91 billion. Its total equity was approximately $16 billion. The unrealized losses had essentially consumed the entirety of the bank's capital cushion in real economic terms, even though under accounting rules they did not need to be recognized until the securities were sold. On March 8th of 2023, Silicon Valley Bank announced it had sold $21 billion in available-for-sale securities at a $1.8 billion loss in order to rebalance its portfolio, and that it needed to raise $2 billion in new equity capital to shore up its balance sheet. That announcement was the Stage 3 trigger. By the evening of March 9th, $42 billion in deposits had left the bank. Another $100 billion in withdrawals was staged to go out the following morning. In the span of roughly 14 hours, depositors attempted to remove over half the bank's total deposit base. The FDIC seized Silicon Valley Bank on March 10th. It was the second largest bank failure in United States history. The contagion spread immediately to Signature Bank and created severe stress at First Republic Bank, which ultimately failed in May of 2023, becoming the second largest bank failure in United States history before being acquired by JP Morgan Chase. The Federal Reserve created the Bank Term Funding Program to provide emergency liquidity to banks facing similar pressure, allowing them to borrow against the face value of their long-duration securities rather than their depressed market value, effectively preventing the unrealized losses from becoming a liquidity crisis at dozens of other institutions simultaneously. That program expired in March of 2024. It no longer exists. The backstop that prevented the 2023 crisis from becoming systemic is gone. What remains is the vulnerability. Now apply the pattern to April of 2026 with precision, because the data is not ambiguous. Stage 1, the vulnerability construction, was built across the same cycle that created the Silicon Valley Bank collapse, extended further by a commercial real estate lending boom that predates the rate hikes and is now colliding with an extraordinarily difficult refinancing environment. The FDIC's own fourth quarter 2025 quarterly banking profile, released in February of 2026, reported that the banking industry is still carrying $306 billion in unrealized losses on securities portfolios. That is down from the peak of over $500 billion when rates were at their highest. But it is still dramatically elevated above the historical norm for a banking system not under interest rate stress. And critically, those losses declined partly because the 30-year mortgage rate fell in late 2025, improving the mark-to-market value of mortgage-backed securities. As of April of 2026, the 30-year fixed mortgage rate has climbed back above 6.4% following the Iran war shock, reversing some of that improvement. The Federal Reserve is holding rates steady at 3.50 to 3.75%, with no credible path to cuts in the near term given oil-driven inflation now tracking toward 4% annually, according to OECD projections. The unrealized losses are not resolving. They are stabilizing at an elevated level in a rising rate risk environment. And the commercial real estate exposure adds a second layer of vulnerability that is structurally different from the securities portfolio problem, and potentially more severe in its ultimate impact. Regional banks now hold almost 1/3 of all United States commercial mortgages. New loan level research cited by Morningstar and others in late 2025 found that the latent distress in these portfolios, meaning loans that would be underwater at current market values, is approximately 4 times larger than what current delinquency rates imply. In other words, the official delinquency statistics dramatically understate the real exposure because many of those loans have been extended rather than resolved. Nearly $900 billion in commercial real estate loans are maturing in 2026 alone. Some analysts describe the broader 2025 to 2029 window as containing over $4 trillion in commercial real estate refinancing need. Regional banks originated a substantial portion of those loans. They are now the institutions that must decide whether to extend the loans again, accept the loss through a workout, or force a default that would require them to recognize losses and further deplete capital. And they are making those decisions in an environment where the Iran war has widened investment-grade credit spreads to 120 basis points, has pushed high-yield spreads toward 470 basis points, and has created what financial analysts described on March 18th of 2026 as the most significant credit market stress since the 2020 pandemic. As of April 6th of 2026, S&P Global Market Intelligence data showed that credit loss allowance ratios at banks for commercial real estate loans were actually declining in the fourth quarter of the 2025, falling 12 basis points quarter over quarter and 17 basis points year over year. Banks were growing more comfortable with their commercial real estate exposure heading into 2026. Then the Iran war arrived, and as one commercial real estate industry analyst wrote on April 6th, the stress test that produced those clean fourth quarter numbers looks nothing like the environment lenders are operating in today. Banks reduced their reserves against commercial real estate losses right before the macro environment reasserted the risk those reserves were meant to cover. Check. Stage 2, the rate shock, is operating in a form that is structurally similar to what preceded Silicon Valley Bank's collapse, but different in one critical way that makes it potentially more dangerous for regional banks. In 2022 and 2023, the rate shock came from Federal Reserve policy normalization, which was a known and partially anticipated risk. In April of 2026, the rate shock has a geopolitical cause, the Iran war, and the energy inflation it has ignited that is fundamentally outside any central bank's control. The Fed cannot address the rate pressure created by oil at $110 a barrel by cutting rates, because cutting rates in an inflationary environment would make inflation worse. It is caught in the stagflation trap that Bank of America described as mild stagflation in their April 2nd, 2026 note. And unlike a policy-driven rate cycle, a geopolitical rate shock has no predictable terminal date. The Strait of Hormuz disruption could last weeks. It could last months. If the conflict extends and oil moves toward $150 a barrel, which Qatar's energy minister warned is possible, the rate environment for regional banks does not improve. It deteriorates. Stage 3, the confidence trigger, has already produced one confirmed bank failure this year, Metropolitan Capital Bank. It is the smallest possible instance of the Stage 3 mechanism, but it is not invisible. The Federal Reserve's own April 2026 stress test scenario, released in February, incorporates a 58% equity market collapse and a 39% commercial real estate price decline as its severely adverse scenario. These are not random numbers. These are the scenarios the regulator believes are within the range of outcomes that stress the banking system. The Federal Reserve does not design stress tests around scenarios it considers impossible. It designs them around scenarios it considers credible. A 10% erosion in core deposits combined with that 58% equity market scenario, according to the stress test framework, could leave several Category 4 banks, meaning those with between $100 billion and $250 billion in assets, dangerously close to the 4.5% minimum capital threshold. The small bank credit card delinquency rate, which I reported in the previous video, sits at 6.6%, 2.3 times the rate at the largest institutions. Those small banks are carrying the most stressed consumer credit portfolios in the system while simultaneously managing commercial real estate exposure and unrealized securities losses. And the deposit base of many regional banks still contains a significant proportion of uninsured deposits, meaning accounts above $250,000 that have no FDIC protection, and which have demonstrated, as Silicon Valley Bank proved in real time, the capacity to leave a bank at a rate that overwhelms any response. The Richmond Federal Reserve published a new economic brief in April of 2026, confirming what historians of banking failures have always known. Bank failures are almost always preceded by weak fundamentals, bad loans, low capital, and declining earnings, years before the actual failure occurs. The runs that follow are the visible event. The invisible deterioration is the real cause. The deterioration is happening now. It is in the data. It is in the unrealized losses. It is in the commercial real estate maturity wall. It is in the widening credit spreads. It is in the consumer delinquency rates. The deterioration is not a prediction. It is an accounting fact. The only question is whether a confidence trigger arrives before the banks can resolve these positions through time, extensions, and gradual improvement in the macro environment. And right now, in April of 2026, the macro environment is not improving. It is getting worse. Let me address the arguments that will be made to counter what you just heard. Because they will be made by the same institutions whose balance sheets we just examined, and by the regulators whose institutional mandate includes preventing exactly the kind of panic they would be validating by acknowledging the risk publicly. The first argument is that the banking system is well capitalized, and the FDIC has confirmed the industry is strong. This is technically accurate at the aggregate level and systematically misleading at the individual institution level. The FDIC's fourth quarter, 2025 quarterly banking profile reported a return on assets ratio of 1.20% for the full year 2025, representing strong earnings at the industry aggregate. But the aggregate hides the distribution. Community Bank quarterly net income decreased 3.8% from the prior quarter in the fourth quarter of 2025. The FDIC itself noted continued weakness in certain portfolios and flagged concerns about commercial real estate loans as matters of ongoing supervisory attention. The credit card delinquency rate at banks outside the top 100 sits at 6.6%. These are not aggregate statistics. These are signals concentrated at specific institutions in specific regions with specific loan compositions. The aggregate is not wrong. It is incomplete. The second argument is that the $306 billion in unrealized losses is declining, and therefore the situation is improving. This argument was accurate through 2025, when mortgage rates were gradually declining and the bond market was improving. The argument stopped being accurate on February 28th of 2026, when the Iran war reversed the rate trajectory. The 30-year fixed mortgage rate was 5.98% on February 26th of 2026. It is 6.43% on April 7th. Mortgage-backed securities, which make up a significant portion of banks held to maturity and available for sale portfolios, lose value as mortgage rates rise. The improvement in unrealized losses that the FDIC reported for the fourth quarter of 2025 reflects a mortgage rate environment that no longer exists. The third argument is that the Bank Term Funding Program prevented a crisis in 2023, and the Fed will intervene again if needed. The Bank Term Funding Program expired in March of 2024. It no longer exists. Creating a new facility requires a crisis to justify it politically and legally. Emergency facilities of this kind are designed to prevent a crash in progress, not a vulnerability building at the edges. The Richmond Fed's April 2026 economic brief makes this point directly. Deposit insurance and emergency lending alone cannot prevent crises. Policies that ensure adequate bank capital and sound risk management are essential. The backstop will be available when crisis arrives. It will not prevent the crisis from starting. The fourth argument is that the commercial real estate maturity wall is widely anticipated, and markets have already priced in the risk. This is the most dangerous argument of all. It is the same argument made before every major commercial real estate wave produced actual bank failures. The savings and loan crisis was anticipated by economists years before it materialized. The commercial real estate losses of 2008 were visible in the data long before the banking failures they eventually caused. Anticipation does not equal resolution. Nearly $900 billion in commercial real estate loans still need to be refinanced in 2026, regardless of whether markets have priced in the risk. Every single one of those loans needs a lender willing to extend new credit at current rates. In a stagflation environment where credit spreads are at multi-year highs, where the cost of institutional funding for banks is elevated, and where commercial real estate values are under pressure from weak demand in office, retail, and multifamily sectors, many of those loans will not find a willing refinancing partner at the terms the existing loan requires. The maturity wall is not a narrative. It is a calendar. And the calendar says April 2026. Here is what you actually need to understand and what you need to do. First, understand the two-tier banking system that exists in America right now. The flight to safety that occurred in March of 2023, when deposits left regional banks and moved to the largest institutions because they were perceived as safer due to implicit government backing, has not fully reversed. The academic research on that episode, including work published through the Federal Reserve Bank of New York and the New York University Law School, documented that the deposit reallocation from regional banks to large banks in March of 2023 was unprecedented since at least mid-29. The perception that large banks are safer because they are too big to fail is not irrational. It is historically supported. If you have more than $250,000 on deposit at a single regional or community bank, you have uninsured deposits in an institution that is more exposed to commercial real estate losses, higher consumer delinquency rates, and lower capital adequacy compared to the largest national institutions. That is not a moral judgment about regional banks. It is an arithmetic observation about their balance sheet composition relative to their capital cushion. In a stress scenario, the sequence that matters is whether the cushion is sufficient to absorb the loss before confidence erodes. Second, understand that the commercial real estate maturity wall affects not just the banks directly, but the borrowers, the communities, and the local economies those regional banks serve. When a regional bank faces capital pressure from commercial real estate losses, it does not simply absorb those losses quietly. It restricts new lending. It tightens underwriting standards. It reduces credit availability in the small and mid-sized business sector that depends on regional banks for capital. The Federal Reserve's own research has consistently shown that credit contractions at regional banks have significant negative impacts on local employment and business formation. A regional banking stress episode in 2026, even one that does not produce the dramatic bank run headlines of 2023, will tighten credit for the small business owners, the commercial property developers, and the ordinary borrowers who rely on the regional banking system in ways that compound the stagflation damage to household purchasing power. Third, understand the concentration risk in the current commercial real estate office sector. Office mortgage delinquencies have been rising even as the overall commercial real estate picture appears manageable. Remote work has permanently altered the demand for office space in virtually every major American city. The occupancy economics of office buildings that were financed at peak valuations in 2018 and 2020 are structurally impaired in a way that is not cyclical. It is not reversible through lower interest rates. The buildings are worth less because fewer people work in them. The loans on those buildings were made when they were worth more. The gap between current value and outstanding loan balance is a loss that must be absorbed by someone. A meaningful share of those loans are on regional bank balance sheets. The question is not whether that loss will be recognized. It will be recognized. The question is when, and whether the sequence of recognition is managed gradually enough to avoid triggering stage 3. Fourth, understand what the earnings season beginning this week tells you. Goldman Sachs reported Monday the 14th of April. JP Morgan Chase, Wells Fargo, and Citigroup report Tuesday. Bank of America and Morgan Stanley report the following Wednesday. Large banks are expected to post strong earnings from investment banking fees and net interest income. The large bank results will dominate the financial press. They will be good. They will reassure markets. And in doing so, they will obscure the story that actually matters for the regional banking system, which is not the story of Morgan Stanley's merger advisory fees, but the story of the smaller institutions reporting later in the earnings season, the ones carrying the concentrated commercial real estate books, the elevated small business delinquencies, and the unrealized securities losses that do not show up in JP Morgan's results. When you hear that bank earnings season was strong, ask which banks. Then look at the specific institutions with the specific exposures. Fifth, understand the digital contagion speed that regulators themselves are incorporating into their 2026 stress testing framework. The 2026 stress test explicitly incorporates what regulators call global market shock components that simulate not a slow recession, but a jump-off volatility where risk appetite vanishes overnight. This is a direct regulatory acknowledgement that the digital bank run mechanism demonstrated by Silicon Valley Bank in March of 2023 has permanently changed the speed at which a confidence trigger can translate into a liquidity crisis. The liquidity coverage ratio, which was designed after the 2008 financial crisis, assuming that between 25 and 40% of large uninsured deposits could flee over the course of a month, was exposed as catastrophically conservative when Silicon Valley Bank saw 60% of its deposits attempt to leave in a single day. Modern bank runs do not unfold over months. They unfold over hours. And in a stagflation environment, with consumer sentiment at the third lowest reading in 75 years, with an active war creating daily uncertainty, with credit spreads at multi-year highs in oil at $110 a barrel, the psychological preconditions for a rapid loss of confidence in a vulnerable institution are more fully assembled than at any point since March of 2023. Here is the pattern in its complete form as it applies to the regional banking system in April of 2026. Stage 1 is complete and documented. $306 billion in unrealized losses, nearly $900 billion in commercial real estate maturities this year, a 6.6% credit card delinquency rate at small banks compared to 2.8% at large ones, securities portfolios built during the zero-rate era that have not fully recovered, despite a year of declining rates, now facing renewed rate pressure from the Iran war. Stage 2 is active and intensifying. Mortgage rates have reversed their improvement and are climbing again. Credit spreads are at multi-year highs. The cost of wholesale funding for banks, the kind that does not come from loyal retail depositors, but from institutional money markets and time deposits, is elevated and rising. The stagflation trap prevents the Federal Reserve from cutting rates to relieve the pressure on bank balance sheets without making the inflation problem worse. Stage 3 is the open question. Silicon Valley Bank's trigger was a single earnings announcement about a bond portfolio sale. First, Republic's trigger was contagion from Silicon Valley Bank. The triggers of previous crises, Penn Square's failure for continental Illinois, the oil price collapse for the savings and loans, were not individually dramatic. They were catalysts that exposed vulnerabilities that had already been built over years. The vulnerability in the regional banking system right now is not hypothetical. It is in the FDIC data. It is in the credit spread widening. It is in the commercial real estate maturity numbers. The trigger that completes stage 3 is the unknown. It could be an earnings announcement from a mid-sized regional bank reporting unexpected commercial real estate losses. It could be a credit rating downgrade. It could be a news report about a specific institution's exposure. It could be something entirely unrelated to banking that simply depresses confidence broadly enough to shift deposit behavior at the margin. Stage 4 of the resolution will look like 2023 if regulators act quickly and if the number of affected institutions is manageable. It will look like the savings and loan crisis if the commercial real estate maturity wall produces a wave of defaults that overwhelms the capacity of any single intervention to contain. The evidence does not yet tell us which of those outcomes is more likely. But the evidence is clear that the conditions for Stage 3 exist and are present right now in April of 2026 at vulnerable regional institutions carrying concentrations of risk that their aggregate financial statistics are specifically designed to obscure. The Richmond Federal Reserve said it directly in their April 2026 brief. Failing banks consistently exhibit declining capital, rising asset losses, and growing reliance on expensive wholesale funding years before failure. This holds across institutional regimes and with and without deposit insurance or a public lender of last resort. The pattern is in the data is public. The question is whether you see it before the trigger arrives or after. Subscribe to this channel right now. The first major regional bank earnings from the smaller institutions that actually carry this exposure will begin arriving in the next 2 weeks. Every commercial real estate delinquency number, every deposit flow figure, every reserve adequacy disclosure will tell you something about how close Stage 3 actually is. Hit the bell. Because when the next Silicon Valley Bank moment arrives, it will not announce itself in advance.